Good afternoon and welcome to Business Spotlight on MITV Plus, where we bring you news stories and interesting conversations and discussions around the business fair. Today, the 18th day of May 2026, I am Layo Shobo for Lauren Shaw and delving straight into the news. The federal government, through its Bureau of Public Procurement, has barred government ministries, departments, and agencies from processing upward revisions of contract sums without first obtaining a Bureau certificate. This was as it issued other sweeping guidelines that centralize the review of all contract variations and scope modifications under its authority, according to a statement signed by its head of press and public relations, Zira Naga. The Bureau said the reform is designed to close one of the most persistent channels for cost inflation and corruption in Nigeria's public procurement system. The guidelines, issued pursuant to Sections 5A and 0 of the Public Procurement Act 2007, give effect to a Federal Executive Council approved policy conveyed by the Secretary to the Government of the Federation in December 2025. The new guidelines replace an earlier 2013 framework that required presidential approval only for variations above 15% of the initial contract sum, or 1 billion naira. Under the new framework, every request for a variation order, fluctuation claim, or scope modification, regardless of size, must first be submitted to the BPP for preview and certification before proceeding to relevant approving authority. The Central Bank of Nigeria says 63.3% of Nigerians want interest rates reduced ahead of the Monetary Policy Committee meeting scheduled for May 19 and 20, 2026. The Apex Bank disclosed this in its April 2026 Inflation Expectation Survey report released by its Statistics Department under the Economic Policy Directorate on its website and obtained by Newsman. The report found that most respondents preferred lower borrowing costs despite persistent inflationary pressures across the economy. It stated, the survey revealed high public engagement with CBN communications, 92.1%, a general perception of transparency, 93.3%, and a strong desire for a reduction in interest rates, 63.3%. According to the report, 26.0% of respondents wanted interest rates retained at current levels, while 10.7% supported a further rate hike. The development comes as the MPC prepares to take another decision on the monetary policy rate amid concerns over inflation, exchange rates, pressures, insecurity, and rising energy costs. Meanwhile, Nigeria's financial institutions are fighting to meet the deadline of June 10, 2026, set by the Central Bank of Nigeria for onboarding to a new cybersecurity baseline. Industry experts said that though most of the commercial banks are already on track to the deadline, almost all operators below them are not ready yet, and the situation exposes the entire system to new risk a baseline was set to prevent. Reports say that only Tier 1 banks and a few others are likely to meet the deadline, but smaller institutions are lagging due to non-existence of Chief Information Security Officers, CISOs. The new cybersecurity standard was meant to check anti-money laundering, combating financial terrorism, and counter-proliferation financing solutions. The Securities and Exchange Commission (SEC) has warned Nigerians against investing in unregistered online investment schemes being aggressively promoted on social media platforms, cautioning that many of them exhibit characteristics of Ponzi schemes. The warning was contained in a public notice dated May 8, 2026 and published on the Commission's official communication channels. According to the Apex Capital Markets Regulator, several of the online platforms promising guaranteed or unrealistic returns are neither registered nor authorized to operate within Nigeria's capital market. SEC stated that the Commission's attention has been drawn to the increasing promotion of unregistered online investment schemes on social media applications and websites, including WhatsApp, Instagram, Telegram, Facebook, TikTok, and other digital platforms. A tax expert, Olayinka Oyebola, has urged tax practitioners across the country to prioritize ethical standards over short-term gains in their professional operations. Oyebola gave the charge in a statement to practitioners under the aegis of the Chartered Institute of Taxation of Nigeria while speaking on the conference themed Tax Reforms and Global Relevance, Positioning Nigeria's Tax System for a Sustainable Future. He stated that integrity of the profession rests entirely on the unwavering ethical conduct of his practitioners and maintained that practitioners cannot afford to compromise on standards if there must be a lasting trust with the public and the government. Reflecting on recent international regulatory challenges, Oyebola maintained that transparency remains the ultimate guide for global operations. Into this very interesting story, a new national study has revealed a profound mismatch between female enterprise ownership and access to institutional finance in Nigeria, disclosing that while women own nearly 40% of businesses across the country, they continue to receive a disproportionately small share of formal credit. The Gender Equity and Social Inclusion Baseline Report, introduced by the Impact Investors Foundation in Lagos, laid bare a stark systemic capital mobilization gap, noting that a mere 23% of Nigerian women currently hold formal bank accounts compared to 77% of the male counterparts. The Chief Executive Officer of the Impact Investors, Itemori Glover, who spoke on the theme From Commitment to Action, Strengthening Inclusive Gender-Lens Investment for Nigeria's Growth, the GESI Baseline Report is more than a document. He said it is a data-driven foundation required to fix structural barriers in the financial system. According to that, while women own nearly percent of Nigerian businesses, they receive a disproportionately small share of formal credit. This report empowers stakeholders to identify acute gaps and benchmark progress as we move toward a truly inclusive economy, he said. The economic urgency of the report's findings was further underscored by critical banking data highlighted at the summit. The president of the Dangote Group, Aliko Dangote, has reaffirmed his commitment to boosting food security across Africa through large-scale fertilizer investment, declaring that the continent has the capacity to feed itself and become a net exporter of agricultural products. Dangote made this known while addressing journalists in Gode in Ethiopia's Somalis region during a high-profile visit hosted by Prime Minister Abiy Ahmed. The Prime Minister personally received Dangote and accompanied him to inspect the site of the proposed fertilizer plant, where construction activities are already underway. Speaking on the strategic importance of fertilizer in agricultural productivity, Dangote noted that Africa's food insecurity challenges are largely due to limited access to key inputs. And from agriculture to oil and gas, oil prices rose to $109.3 on Sunday amid the unending tension in the Middle East, data by oilprices.com has shown. This was as the United States President Donald Trump warned Iran that the clock is ticking after talks to bring the war to an end continues to stall. From about $107 a barrel last week, oil prices continue to go higher, impacting the cost of refined petroleum products at the pump. Recall that Trump had last week rejected the proposal by Iran to end the crisis and open the all-important Strait of Hormuz. Iran had remained in control of the strait since the war started in February, making transportation of oil impossible. On Sunday, Trump warned Iran to act fast or lose everything. They better get moving fast or there won't be anything left of them. Time is of essence, he wrote on his Truth social platform. The BBC reports that the message came as the president was due to speak with Israeli Prime Minister Benjamin Netanyahu on Sunday. Trump also warned earlier that the ceasefire agreed with Iran was on massive life support after rejecting Tehran's demand to end the war. And now we'll bring you the interview segment of our Business Spotlight today. We shall be concluding the discussion that our correspondent Abiola Ismail had with the former Deputy Governor of the Central Bank of Nigeria, Dr. Babatunde Lemo, where they discussed Nigeria's banking recapitalization exercise. Let's join them now. Over to you, Abiola.
Hello, you're welcome to your favorite program, Business Spotlight. My name is Abiola Ismail, and today we shall be looking at the recapitalization exercise and its impact on the Nigerian economy. I have no other person to discuss this issue than the former Deputy Governor of the Central Bank of Nigeria and a former Managing Director of Wema Bank, the person of Dr. Babatunde Lemo. You're welcome, sir.
Thank you very much.
You're welcome, sir. There are concerns that banks may remain risk adverse despite high capital. How can this be addressed?
Yeah. First, there's nothing wrong in banks being risk averse. I've been a banker all my life before I went to CBN. Even coming out of CBN, I still remain a banker. I was chairman of the bank. People should not castigate banks for being risk averse. In fact, a good banker should be risk averse. But how do we then do that? What are those risk elements that make banks risk averse? The most important among them is when the macroeconomy is unstable. You don't want to lend long because you don't have a crystal ball that will ensure that you can guess what will happen in the next 5-10 years almost with certainty. That's the reason why you cannot have a lot of derivative instruments being active in Nigeria. So what we should therefore do is, how do we remove those risk elements, or how do we have a market where you can diversify away those risk elements through derivative products that banks can do? In other words, if they lend into that sector, what made them to run away is, should anything happen to that sector, what are their remedies? If we begin to think along that line, then it will be easier to get the banks to be less risk averse. Another major reason in Nigeria, for instance, is the legal environment. As a banker in those days, I would rather do import finance facility or lend you money to buy quoted shares than to give you money and then you give me legal mortgage as security. You give you money for manufacturing. Because what you are manufacturing may be feasible today because raw material is banned. But tomorrow, if if importation is allowed, then it can upset the whole thing. I used to lend to cocoa producers, cocoa industries in those days, because of course the military government banned the export of cocoa beans. You need to do value addition, which was good. And so many of them got machineries to do cocoa processing. But guess what? After some time, there was pressure from international community, and then they removed that. And so they just couldn't find cocoa anymore to process, and then those credits went bad. So these are things that have to happen. The economic managers must sit down and say, what are those important risks that are making banks to be risk averse, and let's reason together and remove them. Legal environment is also there. If abroad, if you default on your loan and there's disputes, within 3 months you know that there will be judgment. Within 4 months the house can be sold, but here you can be there till kingdom comes.
Yes.
There's double whammy. Your money is in the hands of the customer. It's deposit that depositors can ask for refund tomorrow. But not only that, even if you have judgment after 10 years, nominally, you have lost 80% of that money. So these are things that can be done. The banks are rational economic agents. They will continue to be risk averse, otherwise they will run that bank aground. And the only way out is for all of us to reason together to see how to remove those risks.
Now, how can banks balance profitability with their responsibility to drive inclusive economy?
Banks are commercial institutions. Like we normally jokingly say, nobody has come to Lagos to count the number of bridges. The owners of banks are you and I that have shares in those banks. They don't have a responsibility to do CSR. They don't have a responsibility to do financial inclusion. That is why financial inclusion and all those activities, they are in the hands of government. Central Bank has been at the vanguard of ensuring financial inclusion with Bill and Melinda Gates Foundation and so on and so forth. Federal government is also doing a lot through the Ministry of Investment and so on and so forth. That they should continue to do. However, there are ways by which, of course, banks can be encouraged to do that. Through, by providing incentive. You have the cash reserve requirements. You can say that if you do more financial inclusion, I will reduce your cash reserve requirement. That's the money that is quarantined in central bank. If you have a deposit of so much, minimum percentage you should reserve with central bank. You can do that. You may not use CRR. You may use, even in the competition of your liquidity ratio, there's so many things. Or tax credits. Those are the things you should provide to then provide incentive to bank. But if you sit down and say, banks, you want to do financial inclusion, you are distracting them. They don't have such responsibility. The responsibility they have to their customers is to maximize profit so that you get your dividend and you go. However, they are also human beings. They are rational economic agents. Make it profitable for them. They will do it. Even by giving them award, as symbolic as that, may also be something. Maybe during the annual bankers dinner, give award to top 3 banks that have this opportunity and let them go to Mr. President and he shakes hands with them that yes, you are helping to lift up our economy. Every bank wants to be so praised. They can then use it in their newspaper to say, we are the best market-friendly bank. These are things that can be done to improve the access to credit. I can tell you also, Bankers Committee has been doing a lot of that in collaboration with the central bank.
Okay. In the face of this recapitalization we are talking about, do you see Nigerian banks competing favorably with international banks?
Of course, yes. Prior to 2006, Nigerian banks were not internationally active. I remember in my days in CBN, there were only just 2 or 3 that had foreign subsidiaries, and they were all just bystanders, even in those places where they were. And their capital level was so small that they couldn't even make much impact here. Most of the sectors, key critical sectors in the economy, especially oil and gas, if the oil companies then needed money, they would rather call for foreign banks and get it with the forest risk and everything than commercial banks. If you see commercial banks in the meeting, they are just there to collect local proceeds and so on and so on. The real big heavy lifting is foreign banks. But that began to taper out as we concluded the capitalization exercise in 2005, 2006. And I just read this morning that one of them, I think the oldest bank in Nigeria, even wants to raise capital again to 1 trillion naira, and they're getting the shareholders nod. So many of them will even go beyond the regulatory minimum and do a lot more. And by the grace of God, Nigerian banks are becoming very, very active, and they are also competing with foreign banks, not only in Africa, but even outside Africa.
But so in the face of inflation, exchange rate volatility and debt pressures, how resilient is the Nigerian banking sector post-recapitalization?
Post-recapitalization, I believe capital naturally makes them resilient. But there are also rules around the foreign exposure that you can take. I know that you are not permitted to lend in foreign currency. In my days, you were not. And if you were, then the limit is set based on your capital. And so with those safeguards, I don't think they are going to be are too vulnerable. That's what we call open position limits, beyond which they shouldn't go. Those regulations are there, and central bank will keep a watch at it so that steep depreciation doesn't allow, that doesn't then mean that the banks will come crashing. What the banks themselves also need to look into is that the customers also that they bank, the customers also must not uh, be too exposed to foreign currency obligation. Because if that happens, many of those companies can begin to have problems. And when they do, and they are net borrowers, of course, the thing can seep into the banks that lend them money. These are things that banks themselves should do. Does that then mean that we are completely immune? No. The solution at the end of the day is to achieve macroeconomic stability. And we've seen that stability now for about 7, 8 months. The exchange rate has been fairly stable. If this continues over time, then it's going to reduce that possibility to a very, very, remote possibility. And that's why we're saying that banks don't exist in a vacuum. The success of banks depends on the success of the economy.
And do you think recapitalization alone is enough to stabilize the financial system, or a broader structural reform needed?
We've said it. A who does not make a monk, the capitalization alone does not even make a bank successful. That is even looking at it from micro perspective. If you then look at it again from macro perspective, enough capitalization is good, is necessary, but not sufficient condition. There are also other complementary things that must be to ensure that we have a very strong and resilient economy. We must deal with those things that will reverse the progress that has been made by the government. And the biggest animal in the room today is security of lives and property. Because without security of lives and property, there cannot be meaningful development. I think government should do a lot more on that. That is the biggest headache that we have. The entire middle belt is almost completely gone in terms of risks. You go to Kwara now, many communities have evacuated. Why should that be? You go to our food basket, Benue, Loa, all of those things, farming, no reasonable farming can be done. And so these are things that government need to look into. Once that is done, we must diversify our economy so that we don't depend only on one product. There has been progress on that, but that progress should be done more. We should make more progress. We should try as much as possible to improve infrastructure. If infrastructure, you see, remember, there used to be a time some 35, 40 years ago when we had more than 250 textile companies in Nigeria. They all disappeared because of the decay in infrastructure. Those Chinese and Indian companies that came realize now that they came because the infrastructure in their countries were not as good as infrastructure in Nigeria. And when we began to decay and they improved, there was a reverse industrialization. They all folded up and they're back in their respective countries. So these are things we need to look at. The infrastructure challenge is still humongous. We thank God for what is happening. Look at the coastal road, it's opening up so many things, and many more we should do. The rail line, we've done, I was called government 35% there. There's a lot more that should happen along the rail so that the heavy equipment can be hauled by the rail. Our roads will be better preserved, that can be efficiency driven, because once your economy is very efficient, this is an economy that is set to run on account of the resource endowment that we have, and even human capital endowment.
What other role do you think banks can play to supporting government efforts to grow the economy and reduce unemployment?
It's also it's by looking into the real sector. The more they do in the real sector, the more the real sector builds capacity. And the more capacity that is built, the more employment that people have. Look at Dangote refinery, the number of people in employment. Just imagine having a huge fertilizer plant that does same thing. We have look at the header farmer crisis and all of this. Why should we be having grazing? If you go to, for instance, my own state, Ogun State, if you go to Ogun North and then you do a very big ranching there, and then put abattoir there, so that as you do ranching, you then put refrigerated stock that will bring those things. Look at the value chain, the number of people that will be employed. People will no longer be killed on farms, and then there is employment. It's for banks to do more for government to encourage banks to do more into real sector lending, then they will improve their operating capacity, and that is when unemployment can be reduced.
And how will you assess the regulatory approach of the CBN during the recapitalization process?
Extremely spot on. They were spot on. The capital verification was very rigorous. You see, if you don't want the capitalization exercise to be an exercise in futility, you must ensure that those monies that are moved into banks are real, genuine capital and not just movement of funds. Cash is fungible. I can show you a position now just to satisfy you, and then the moment you turn your back, I move it back. But they're very, very thorough in what they have done. I mean, given my vantage position as a former deputy governor of Central Bank, I knew what happened, and I give them kudos for a job well done.
Very good, sir. And what additional policies or reforms will you recommend to ensure the gains of recapitalization is sustained?
Additional policy reform is what we've said earlier. Let's remove risks so that banks can do more what they have to do. Let's also, through fiscal action, ensure that we have very stable macroeconomic environment. Let's improve infrastructure. Let's improve legal environment, just so that there will be the ease of doing business can be improved upon. And then, of course, these are things that have to happen when then they can make good use of the capitalization. Otherwise, the lending opportunities will be limited, and then risk can begin to emerge if they overlend to a particular sector and undersupply other sector. The other sector will be starved of funds. The sector that is overlent, then bubble will build in those sectors. We should avoid that.
And how can regulatory authorities ensure compliance without stifling innovation in the banking sector?
Compliance without stifling innovation is so easy because you see, the regulators are not static, which is again why I like the present administration. The former CBN, when they had of other the bitcoins and so on and so forth, it was no, don't go there, and so on and so forth. These guys came and said, no, let us not stifle innovation. Let us study what it is all about. And then we'll come up with regulations that will ensure that instruments that are gaining global acceptance are not just shut down because we don't understand it. So we are beginning to see a much more friendly regulatory environment where the regulators themselves understand that they need to know more about the market. They need to know better about the market. That's the only way they can make it happen. Otherwise, if you just become draconian and anything you don't understand, you say it should not be. Nature abhors vacuum. That is when you can see them bypassing regulation, or what I call regulatory arbitrage, looking for other sectors where that is not banned and then moving resources into those areas. The best way is for the regulators themselves to understand, be more collaborative with operators. Let them also understand the dynamic nature of the global economy, not just Nigerian economy, because the entire economy is fusing into one mega economy. And by so doing, they will be on top of their game and they will be better able to supervise. They must not stifle innovation, otherwise we'll be left behind.
And lastly, let's look at what's your outlook on Nigerian banking industry in the next 3 to 5 years?
Nigerian banking industry will continue to grow. Why am I saying that? Because when you look at the credit penetration, not banking penetration, at the credit penetration, the size of the economy, our GDP size, and then the level of bank credit, there's still sufficient scope for more. In other words, we are not seeing sufficient level of credit that matches the size of our economy. So there's still so much scope. And the way to know this is just go to the SMEs, look at their economic activities, and look at the proportion of their activities that are funded by borrowing. It is still relatively low. So, and all the reasons are the reasons you have mentioned. If we can address those reasons, then we can see the growth in banking services accelerating, even far beyond the growth in the GDP. And so this banking industry will help GDP to gain steady growth. So I see banks continuing to grow in leaps and bounds in the next 4 to 5 years.
And lastly, sir, what lesson has the industry learned from this recapitalization cycle that should be guided for future reform?
Well, the lesson here is I don't think banks should wait until regulators say increase your capital. There's a minimum capital level, capital buffer that banks are supposed to have. As you are growing your business, I believe a bank should actually have headroom that is slightly bigger than the minimum prescribed by the operators, by the regulators. And the reason being that should there be sudden loss of money in terms of, you have an adverse year and so on and so forth, your capital adequacy shouldn't be in the red. If you have that buffer and you always go beyond the minimum capital, anytime there is opportunity, anytime there's an announcement that you should grow your capital, you just smile where you are. Not all the banks were raising capital. I think there are a few that were actually there or almost there before. And so you are no longer part of that rush for money when the announcement is made, because you naturally have embedded, periodic and regular capital raise as an integral part of your business, which is why I commend the bank that announced that they are raising their capital to 1 trillion. This is not regulator induced. So as long as operators do more and more of that, they've made the work of the regulator easier. And the knee-jerk thing that we see when they are asked to go and raise capital and the scamper for money will not be there.
Thank you very much, sir, for your time. We've been talking to Dr. Babatunde Lemon, former Deputy Governor of the Central Bank of Nigeria, and he has been giving out incisive lessons to learn from the recapitalization exercise and the impact on the industry. I hope you enjoyed it. Over now to Layo for the rest of the story. My name is Abiola Ismail. Thank you for joining us.
Thank you very much, Abiola, for that wonderful conversation. And this is where we draw the curtain today on Business Spotlight. Thank you so much for joining us. Join us again tomorrow for another interesting edition. Do well to follow us on all our social media platforms at MITV+_NG on Facebook, Instagram, TikTok, and X. You can also watch our programs live on YouTube at MITV+_NG. Remember to click the like and the subscribe button. I am Layo Shobo for Lawrence Shaw. Do enjoy the rest of the day.